They just won't take our rice, even though they desperately need it. Imagine reading that fiery proclamation from the President of the United States, accusing an entire nation of refusing one of the most basic staples on the planet. That revelation would be enough to jolt anyone out of a sleepy news scroll. So, what on earth is really going on behind the scenes of these trade tensions? And how did London's markets end up responding to the swirling drama? Today, we will journey through the twists and turns of a financial landscape that is anything but stale. Corporate giants are dealing with consumer jitters, energy corporations are on the rise, and one of the United Kingdom's most iconic retail chains faces pressure despite posting stronger than expected numbers. In this exploration, we will cover the surprising leaps of certain stocks, the stumbling of companies that once seemed unstoppable, and the perplexing signals from across the pond that have left analysts scratching their heads. We will delve into a swirling mix of data, from manufacturing indices to fresh job openings, weaving together a story filled with suspense, drama, and a few turns you may not see coming. If you think the daily market updates are dull, let me assure you, there is more intrigue here than meets the eye. In this episode, we will tackle the central questions swirling around investor confidence in the face of shifting trade dynamics, investigate how certain industries are defying the odds while others sink under the weight of consumer anxieties, and reveal the real story behind unexpected spikes and dips in the data. Buckle up, because we are about to embark on a deep dive that could transform how you view not just the British markets, but also the global economy. Along the way, do not be surprised if you find parallels to issues that resonate in your own day-to-day life, like how consumer confidence can suddenly sag when the mood shifts, or how the promise of potential trade pacts can be dashed by a single social media post. First, let us set the scene in London. Picture the capital awash in a flurry of market wraps and midday bulletins as the new trading session tips off. The tension is palpable, with investors on edge over fresh announcements. Then comes a surprising consensus. The FTSE 100 index, the bedrock of UK equities, actually closed higher, showing that 0.3% gain everyone was itching to see. Yes, you heard that right. Even with the constant tension over overseas tariffs and questionable signs from key economic indicators, the FTSE 100 defied doom and gloom predictions and inched upward to finally settle around 8,785.33. Meanwhile, the FTSE 250 posted about a 0.5% climb to edge around 21,743.16, and the AM All-Share also notched a 0.3% uptick, dancing near 772.94. Are these modest gains or signals of something bigger? Let us not forget that underneath these headline figures lurks a complex narrative. On one hand, the markets are buoyed by perennial optimism. Investors love to focus on the bright side of any half-baked news. On the other hand, you have the usual swirl of trade tensions emanating from the United States, where confusion reigns over how many new deals the current administration can realistically hammer out. What about all those harrowing headlines about weakening global demand, uncertain consumer appetites, and shifting macroeconomic climates? Should these not dampen the mood more significantly? And that brings us straight to one of the day's most contentious news items, the situation of a major British staple, the long-standing titan of supermarket aisles, Sainsbury. Despite unveiling stronger than expected sales for its most recent quarter, retail sales grew faster than analysts had predicted. The company's stock still took a 1.1% hit, dipping down just when you would assume it might skyrocket. There is a biting irony in seeing numbers come out better than forecasted, only to witness investor unease because there was no upgrade to the store's forward guidance. Think about it for a minute. You hit your quarterly sales out of the park, and the markets reward you by shaving a little off your share price, basically telling you, nice job, but we wanted more fanfare. With zero guidance updates, the question arises, do you think Sainsbury is playing it safe by not inflating expectations? Or is it a sign they are uncertain about the months ahead? Of course, the push and pull of supply chain hiccups and consumer demand is not limited to retail. Enter the energy infrastructure space. National Grid and SSE, two colossal forces in the realm of power and utilities, extended their gains in the wake of regulatory body Ofgem's draft plan to pump a substantial sum, think tens of billions of pounds, into overhauling gas networks. Specifically, we are talking about roughly £24 billion in proposed investment. Let that sink in. That is a colossal infusion into the sector, fueling speculation that the future of British energy might be on a steadier and possibly greener track. One cannot help but wonder, could such an enormous boost in spending drive new jobs and revamp how we think about power distribution for decades to come? But not every company can ride on the wave of good fortune. Kitwave, a wholesaler in the food and beverages space, has been struggling. It plummeted more than 20% after warning that volumes in the leisure sector were weakening. What drives such a precipitous fall? Sometimes all it takes is a single line from the leadership mentioning fragile consumer confidence to send investors rushing for the exits. If you have ever pivoted your weekend plans from an extravagant dinner to a modest home-cooked meal, you can relate to the real-world macro effects that are trickling down to companies like Kitwave. A similar tumble happened to MPAC Group. The packaging automation specialist shed a startling 28% on news that its order intake in the second quarter was not just slow, it was alarmingly so. Market uncertainty, consumer confidence, multiple variables swirling around from trade to supply chain constraints. It all converged like a perfect storm. MPAC's leadership essentially said, "We simply cannot see ourselves hitting the lofty revenue targets we previously projected." That is the kind of admission that typically sends stock watchers into a frenzy. Now, let us swivel our gaze across the Atlantic to the United States, where the data is enough to make even the most battle-hardened analysts scratch their head. On the same day, two major manufacturing reads released figures. One, the S&P Global Manufacturing PMI, ticked up slightly from last month. That would suggest, in some corners, that manufacturing is humming along, maybe even picking up pace. But then you look at the Institute for Supply Management's separate gauge, which was still signaling contraction, albeit a somewhat gentler contraction than the previous month. So, which are we supposed to believe? To deepen the puzzle, the ISM also noted that pricing pressures remain uncomfortably high, with its prices paid index climbing into the high 60s, which is definitely not the best news if you are worried about inflation. Meanwhile, corporate purchasing officers remain very reluctant to ramp up inventory with all the confusion about tariffs. One can hardly blame them. When your supply costs could skyrocket tomorrow because of some new policy tweet, how do you plan effectively? Then there are the job openings. When those official numbers dropped with an unexpected spike to well over 7 million, economists scrambled to interpret the significance. Some said it contradicts other signs that the labor market is cooling, while others argued that we simply need a few more months of data to see if this was a fluke. But here is what is particularly dramatic. The White House has been rolling back on its previously lofty plan to finalize 90 trade deals in 90 days. We are beginning to see a pattern of smaller, piecemeal agreements instead of a bold, sweeping approach. That shift alone can create massive uncertainty in how companies plan their supply chain strategies. In the context of this swirling mess, it is not surprising that we saw a bit of a roller coaster on Wall Street. The Dow eked out some gains, while the S&P 500 faintly dipped and the Nasdaq slid a bit more. Appropriately, shares in technology and growth-oriented segments can be particularly sensitive to factors like interest rates and global consumption patterns. So, we saw a situation where industrial giants might have a reason to cheer, while tech watchers scratch their heads in concern. The big question that arises for energetic watchers of the markets is this: are we witnessing a short-term bounce buoyed by overzealous optimism, or could these incremental gains reflect an actual turning point? Are the apparently contradictory data points from the U.S. manufacturing sector just noise, or do they presage deeper shifts in consumer demand and corporate sentiment? Let us pivot back to the London scene for a moment. In the same breath as these fairly positive numbers for the FTSE indices, we have to ask, how will a continuing meltdown in the macro outlook hit those carefully laid growth plans for various British businesses? Is the impetus from a strong spending plan in the energy sector enough to offset gloom in leisure consumption and packaging automation? Take a moment to reflect. If you are Sainsbury, boasting of better-than-expected sales in your supermarket aisles, but worried about how a widespread slump in consumer sentiment might affect the next quarter's numbers, do you promise big or brace for the worst? If you are an energy infrastructure company, do you ramp up investments now, confident that new capital expansions could pay off if the country edges closer to energy independence? Or do you hold back out of caution over unpredictable regulatory or political shifts? So many crossroads lie just ahead. If you are enjoying dissecting this puzzle as much as we are, let me offer a quick suggestion. Do not hesitate to show a little support maybe even a friendly gesture like liking this analysis, if you want more deep dives into these perplexing financial twists and turns. Sometimes, a simple thumbs up can signal to our team that you value this brand of thorough, story-driven commentary. All right, let us march forward. We have touched on consumer sentiment quite a bit, and it keeps surfacing in almost every corner of the market narrative. Nobody is immune. Large corporations are forced to do frantic forecasting. Retailers like Sainsbury are hedging their bets about future sales, and manufacturers watch as new orders constrict or expand based on a swirl of economic data and trade news. Meanwhile, the uncertain political climate in the United States complicates matters, since so many global supply chains run through or near the American marketplace. Tariffs, or even just talk of tariffs, can shift fortunes overnight. It is also worth noting how overshadowed the good news can become when overshadowed by the truly unexpected. Sainsbury, once again, posted like-for-like sales growth in the mid-single digits, an impressive feat for a supermarket chain that has been around for so long. Yet, the share price reaction underscored a core truth. If companies fail to bolster forward guidance, the markets can respond with a collective shrug. The logic is, well, that was nice, but tell us something that will justify a higher valuation in the future. This is where the conversation about ring-fencing retail optimism meets the skepticism of market participants who have been burnt before. It is a delicate dance. National Grid and SSE, by contrast, have stronger tailwinds behind them in the form of that massive capital injection from Ofgem's draft plan. But do not forget that these big infrastructure undertakings can be a double-edged sword. While the billions earmarked for modernization might boost investor sentiment, the actual execution can be fraught with challenges: prolonged project timelines, cost overruns, regulatory snags, and shifting political support. We see the headlines about £24 billion, but the question is, how long until that capital truly trickles down into verifiable returns on investment? Consider Kitwave's predicament a cautionary tale. This company is not brand new, nor is it immune to cyclical downturns, but management singled out fragile consumer confidence and macro volatility as points of real concern. Their entire business thrives when people are out and about, enjoying leisure activities, perhaps tapping into more robust consumer spending. The trouble is, even small wobbles in consumer confidence can spiral. If enough households decide to tighten their belts, entire supply chains can slow almost overnight. If you broaden that lens further, you see MPAC Group struggling with a second quarter slowdown in orders, especially in the United States. Market watchers have a field day trying to parse out whether this is a mere blip or the beginning of a more sustained slump in packaging automation demand. Automation, after all, has been championed as the unstoppable wave of the future. But waves can crest and retreat, especially in times of economic uncertainty. With the U.S. job market sending mixed signals, some indexes say there is growth, others reveal a softening. MPAC gets caught in the crossfire. Now, one might wonder, if trade negotiations had proceeded as planned, if the U.S. had launched the fabled 90 trade deals in 90 days, would today's conversation be different? The White House's about-face, focusing on smaller, piecemeal deals, might be more realistic, yet it injects a sense of drag. Large multinational corporations often prefer sweeping, comprehensive agreements because they reduce the uncertainty of playing whack-a-mole with tariffs or regulatory barriers in multiple geographies. When global supply lines are forced to remain in limbo, even the best corporate strategists can feel paralyzed. In the end, the curious sense of resilience seen in the British markets is a testament to the complexity of global investing. If it were all doom and gloom, we would see sharper declines. Instead, the index has still found a way to inch upward, likely boosted by the optimism swirling around the energy infrastructure announcements and an overall sense that things are not quite as bad as they could have been. Is that enough to sustain a longer rally? Possibly not without more consistent data or clearer trade progress. But we cannot conclude our story here. Imagine yourself a few months down the line. Suppose you are revisiting these developments and notice that the British energy infrastructure projects have begun, that Sainsbury's next quarter might be overshadowed by the sizzling competition in the supermarket wars, or that any experience with rising costs due to persistent inflation might reverberate through the market. The narrative remains open-ended, and that is precisely why so many people keep a close eye on the daily headlines. Every piece of news can shift the puzzle in ways we might not expect. In times like these, you almost hear the refrain, volatility is the new normal. Perhaps the biggest takeaway is to remain agile in your thinking, rather than pinned down by single data points that could change in a week's time. Just as Sainsbury discovered, good news alone does not secure you a spot in the sun for too long. And as Kitwave found out, a relatively small shift in consumer habits can threaten an entire year of planned profitability. Evidently, we are standing at a crossroads where so many unlinked factors, consumer spending, energy investment, packaging automation, U.S. manufacturing signals, trade deals, coalesce into one swirling narrative. Watching the interplay can be as entertaining as any dramatic television series, especially when leaders in power throw in commentary about who is or is not buying the country's rice. If you are someone who loves to unravel multifaceted stories, the markets present an endless trove of intrigue. Before we continue to our final revelations, let me drop in one more gentle invitation. If you appreciate in-depth explorations like this, consider sharing them with someone you think might be equally curious. A quick mention or a friendly subscribe can help ensure you get more of these in the future, and it tells us that this detailed narrative approach truly resonates with you. It helps keep these discussions going. Back to our storyline. Let us now set our gaze on the broader global stage for a moment. The trade picture with the United States still seems precarious, with tariffs never fully disappearing from the horizon. If global quarrels intensify, that might hamper corporate investments on both sides of the Atlantic, sending shockwaves into the British markets and further pressuring the supplies of packaging, energy, and wholesale goods. Then again, if cooler heads prevail, we might realize that a piecemeal approach to trade deals at least keeps the world from rolling back into an all-out trade war. This dynamic interplay of caution and aspiration is not new, but it is evolving. The new variable is how fast information travels and how quickly policies can shift based on tweets, social media posts, or last-minute negotiations. For instance, President Trump's earlier vow to strike a dizzying array of trade agreements in a single 90-day pause might have spurred initial optimism, but as those ambitions are scaled back, the markets begin to factor in a lesser scope of far-reaching reforms, thus adjusting the overall risk and reward calculations. Given this environment, you may be surprised that so many investors remain upbeat about the future. Yet the logic could be, even if we face short-term headwinds, the global economy has a knack for adapting, and eventually pent-up demand or policy corrections might level the playing field. Indeed, the stock market often trades on forward-looking sentiment, rather than the immediate data, which can explain why the FTSE can keep climbing on an otherwise volatile day. Still, the final puzzle piece is that intangible force known as consumer psychology. Sainsbury's comparatively robust first-quarter sales might be a testament to the fact that many households still prioritize groceries and see them as an essential expense. Yet, if the overall confidence sours because of negative headlines, say a major slump in job numbers or a shocking turn in trade negotiations, then retail might not escape unscathed next time around. The success or failure of the next big corporate quarter could hinge on everything from household budgets to bigger structural policy developments. Over in the power sector, National Grid and SSE might continue their climb if Ofgem's plan moves from draft to reality at a quick pace. However, any sign of government hesitation or red tape could hamper the timeline, possibly deferring the benefits. Meanwhile, watchers of smaller companies like Kitwave may also see an opportunity if the leisure sector recovers in time for key holiday seasons or major cultural events. Investors love to place bets on a bounce, though the risk remains if the macro trends continue to weigh on discretionary spending. The great paradox of markets is that they can seemingly incorporate all this chaos without collapsing. Yes, we witnessed stark double-digit tumbles in Kitwave and MPAC's shares, but the broader indexes have so far proven resilient. It is almost as if the labyrinth of global finance is designed to weather storms, with some sectors compensating for the weaknesses in others. If and when we get a clearer resolution on trade, or more stable signals from the consumer side, we might see a more decisive move up or down. At the end of the day, the best vantage point might come from stepping back and asking, which storyline resonates most with my own experience? Do you see yourself scaling back your leisure outings, thereby contributing to Kitwave's woes? Or do you see a bright future for energy infrastructure, aligning with National Grid and SSE's upward momentum? Whichever side you find more compelling, the truth is that each of these threads is tied to a bigger tapestry of global dependence and negotiation. In summation, while the FTSE indices offered a reassuring finish to what started as a shaky session, the undertow of tension remains real. Sainsbury, for all its strong quarterly numbers, exemplifies the precarious nature of success. In a market flush with anxiety, a lack of upgraded guidance can still overshadow actual wins. In tandem, energy giants such as National Grid and SSE bask in the glow of optimistic regulatory moves, but must still contend with the trials of implementing massive infrastructure projects. Kitwave and MPAC, meanwhile, serve as sobering examples of how quickly the shining luster of opportunity can lose its polish when macro uncertainties become too much to bear. And if you are on tenterhooks about American trade policies, rest assured that even analysts are baffled by the contradictory signals. Some manufacturing signals glow green while others flash red. Job openings surge to levels not seen for many months. Yet skepticism lingers about the overall stability of the labor market. Tariffs may or may not be reintroduced in certain forms. It is enough to prompt even the fiercest optimists to proceed with caution. That is the story of this remarkable day on British and international markets. A day that saw an index like the FTSE 100 forging ahead, while cornerstones like Sainsbury encountered shareholder headwinds, despite overshadowing predictions. A day of conflicting data from across the pond in the United States, where manufacturing and job figures delivered puzzle pieces that do not quite fit together. A day of real winners, from the energy giants forging paths for future networks, to those clinging on, hoping that consumer confidence rebounds. Stay curious, stay informed, and keep an eye on how these narratives develop, because one small shift in consumer mood, trade policy, or regulatory stance could dramatically reshape tomorrow's headlines. The markets may be complex, but if this tapestry of shifting fortunes does not pique your interest, then perhaps it is time to ask, what else in the world could possibly outshine the spectacle of watchers waiting to see if billions in infrastructure spending or a new wave of consumer confidence could power an entire economy forward? One final note. If you have stuck with me to the end of this deep dive, I hope it has given you a more vivid, story-filled understanding of what is really happening on the financial stage. Let us keep this conversation alive, and if you want to be part of future explorations, go ahead and subscribe or take a moment to check back frequently for more. After all, the journey of these markets is far from over, and we have only begun to unravel the countless threads that bind them all together.